Thank you for that introduction and to the day. And it's a pleasure to be here. I'm Peter Elsworth from the investor team at Ceres. Whether I get home after this is up to forces greater than
But not God.
forces greater than are on the panel here today. We have a lot to cover in a relatively short amount of time, so I've brought my own presenter. This panel has been asked to consider three questions to kick off the day. Why is climate finance critical to propel solutions to address climate change? What's the role of socially responsible investors? And how can we take a portfolio-wide approach? Once upon a time, those might have been the $64,000 questions. Suddenly, they've become the $64 trillion questions, which is what we're projected to need in clean energy investments over the next 4 decades to keep atmosphere warming within the 2-degree centigrade threshold considered critical to avoid calamitous impacts from climate change. There are many different chapters to the risk story, too many to go into in this discussion of climate finance. But it's important to note that the risk associated with climate change issues is different from the risks analysts and portfolio managers generally consider. For one thing, it's systemic. It affects virtually all asset classes and is not materially reduced by traditional approaches to asset allocation. The risk also looks different when we look realistically at longer time horizons that most investors ultimately have to manage to. There's always been tension between near-term investment return and longer-term obligations. Climate issues raise the stakes by an order of magnitude. The impact that runaway climate change can have on investment portfolios and their performance may be hard to quantify, but companies and projects operating in a climate-altered environment will face unprecedented challenges if their model is business as usual. I'm going to take half a step back here just to say a quick word about us. First slide, please. Ceres brings sector, issue, and policy expertise to mobilize investors and companies to create a more sustainable capital markets and address the most pressing environmental, social, and governance issues facing us today, including those related to climate change. This is our 26th year doing it. Sister Pat talked about the convergence of changing energy and financial markets. That's what Ceres does, with a strong emphasis on the governance work that you do here. A noteworthy number on this slide is the $13 trillion that our 115 INCR members manage. Given that we didn't pick our network name casually, Investor Network on Climate Risk, that tells you that significant investment money is seriously evaluating climate-related risks and opportunities, and understanding that this is not an issue of just security selection, but an action plan for how they strategically think about their entire investment portfolio. Next slide, please. To help jumpstart that process, we came out with a how-to guide that looks at 10 activities common to most investors and how they might be done differently as part of a sustainable investment strategy, including investing in solutions to climate change. Anybody who doesn't have this, please give me a call and I'll make sure you get an e-copy. If you need them for your internal use, we have hard copies available as well. Next slide, please. Last year, Ceres published a report that we titled The Clean Trillion, authored by Mark Fulton. It's a game plan of sorts for closing the clean energy investment gap. We turned we coined the term clean trillion to capture the need identified by the IEA, the International Energy Agency, and others, that within the next 2 to 3 decades, we need to average $1 trillion a year in additional clean energy investments to stay within the 2-degree threshold I mentioned a few minutes ago and avoid catastrophic climate change. Next slide, please. The Clean Trillion Action Plan has 10 recommendations broken down into 3 areas: mobilizing investor action to scale up clean energy investment, promoting green banking and debt capital markets, and reforming climate, energy, and financial policies. The Clean Trillion's available on our website, both the executive summary and the long version. Next slide, please. Overall, the goals of the Clean Trillion are that by 2050, invest an additional $44 trillion in clean energy, an average of more than $1 trillion a year. In the medium term, quadruple new global investments in clean energy from our current $254 billion a year to more than $1 trillion a year by 2030. And in the shorter term, double annual global investment in clean trillion to $500 billion a year by 2020. As a society, as communities, companies, investors, and governments, we have a choice. Either tolerate and essentially bless, through lack of action, runaway greenhouse gas emissions that will significantly alter our climate, or create lower carbon, cleaner energy alternatives that will stabilize and then reverse our pace of GHG emissions. If we're going to change how we source, distribute, and consume energy, manage our water and other scarce resources, it will need to be financed. The panel was asked to consider in particular the role of the socially responsible investor, or any investor for that matter. Investors can take action in several ways. 2 important ones are through the investment choices they make, or through shareholder engagement, getting companies to prepare for and participate in the transition to a low-carbon, clean energy economy. Engagement could take the rest of the session. It won't. You'll spend a lot of time on it in the next day or so. But it's critical to engage your portfolio companies about how they source energy for their business needs and how they use energy in whatever products or services generate their revenues, profits, and shareholder value. If you're not familiar with it, I'd encourage you to take a look at our report, Power Forward, how American companies are setting clean energy targets and capturing greater business value. I think you all know SIX, our shareholder initiative for climate and sustainability. Next slide, please. Last year, the investors involved with SIX filed 148 corporate resolutions on climate and sustainability. 66 were withdrawn because investors believed in the commitments being made by their portfolio companies to constructively work on the climate and sustainability issues that investors were bringing to their attention. You know, many of your portfolio companies are fully capable of internally financing climate-friendly adaptation and mitigation strategies. Other companies can tap the debt markets, ideally by issuing green bonds whose proceeds are specifically designated for climate and other environmentally friendly projects. And if you wonder about investor influence, the recent emergence and growth of the green bond market is more than partially attributable to issuers and underwriters responding to a more diversified investor base, including many socially responsible investors lining up to buy green bonds. Investors that did not commonly show up in the same numbers for conventional bond issues. Finally, the subject of green bonds leads us into the investment vehicles that are available to support projects, products, and initiatives that combat climate change. One of the most frequent questions we hear at Ceres and on our investor team is, well, what climate-friendly investments are out there? Well, the trend is positive. There are more than there were a couple of years ago in virtually all asset classes. Next slide, please. Additional products and strategies are coming almost monthly, and more are needed. This slide captures some of the general opportunities that are available, and it's meant to illustrate that as an investor, if you look, you'll find. We got a bit more specific in our investor blueprint on page 41, if you want to make a note for the whole chart. Next slide, please, because we always run up against the misconception that sustainable investing comes with a performance penalty. In this extract, we show specific strategies offered by some of our INCR members in public equities. They have significant track records, they outperform their benchmarks, and they contribute to some aspect of a more sustainable economy, whether through investments with lower carbon footprints, a focus on clean energy, or better water management. This is just a sampling to prove a point. Of course, we don't endorse any of these, but encourage you to look at the entire landscape that's becoming available and see what makes sense for you. Strategies such as these also start to address the question about where money gets allocated following various decisions to reduce a portfolio's carbon exposure. Next slide, please. Another resource you might look at is the Registry of Low-Carbon Investments that's been compiled by the Global Investor Coalition, which is a network that includes INCR and its brethren in Europe, Australia, and Asia. Together, they've compiled a list of more than 250 clean energy investments that have already been made. This is just a sample, and I invite you to take a look at the whole registry, which is publicly available. If you can't read that, it's globalinvestorcoalition.org. Another project, next slide please, another project of that same Global Investor Coalition is a global solutions guide for climate-aware investors. It's a guide for general opportunities in the various asset classes with examples of specific funds or fund managers that address those opportunities. Investing in solutions is increasingly taking different forms. Green bonds are one, and investors, of course, need to be attentive to the nature of the projects being financed. To that end, a group of green bond investors convened by Ceres will be releasing tomorrow a statement of investor expectations for green bonds. Among its signatories will be 5 investor members of the Executive Committee of the Green Bond Principles, and some of you represented here. The investor statement is meant to support, complement, and build upon the Green Bond Principles that were published a year ago. Because this panel has been asked to consider how one can take a portfolio-wide approach, I'd like to quickly highlight 2 of our INCR members that operate in asset classes not usually considered to be part of the climate solutions discussion. Next, please. Private equity is looking at sustainable investment opportunities few would have thought possible 10 years ago. This extract from KKR's ESG report released last June, its 3rd, recognizes opportunities related to sustainability and climate solutions. Obviously, you need to be selective and learn more about these opportunities, but they and their competitors are becoming part of the climate solutions conversation in some meaningful ways. Next slide, please. Similarly, opportunities can be increasingly found among hedge funds and funds of hedge funds. Another of our INCR members, Terra Verde, is focused exclusively on climate, energy, and water opportunities. It's not an endorsement, but it is meant to be an eye-opener of sorts, which brings me to my last slide. Assess how climate-related risks can impact your investment return. Where are you most exposed? What can you do about it? Plenty of organizations can help you with that kind of analysis. Look for investment opportunities that support climate adaptation and particularly mitigation? Who are the innovators? Who is developing practical, scalable solutions? And finally, a note for the asset owners here. Make sure your managers and consultants understand your priorities. Without direction from you, they'll be doing the same thing they were 3, 5, 10 years ago. Don't let them, by default, set your investment agenda. Thanks.